Hey, realtors, here's everything you need to know about locking versus floating an interest rate when your buyers are approaching a contract. Before we dive into today's topic, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. I'm licensed to do mortgages in South Carolina, North Carolina, and Virginia. If you would like me to help your borrower out, please leave me a comment below, give me a phone call, text message, or email. I will leave my contact information in the video description and in a pinned comment. Okay, so what exactly is locking? Locking an interest rate is when your buyer has obligated the bank to provide a certain specific interest rate, and they are going to offer it for a certain period of time. That means the bank can't change that as long as the parameters of the mortgage don't change, right? There's no change to credit, maybe no change to down payment depending on the program, change to other things that could throw off the pricing. The bank is committed to giving that interest rate. In typical lock periods, meaning how many days the bank is going to be obligated to give that interest rate, the most common are 15, 30, 45, 60, and 90 days. There are other lock periods, 105, 120, but those previous ones, those are the most common. There are also extended lock periods, but those may come with increased fees, and they're not as common now as they were during COVID, nor is the value of them as good now as when we were in a much lower interest rate environment. Generally speaking, the longer the lock period, the higher the interest rate. It doesn't necessarily mean that it's definitely going to be that way, but that is generally how it works. A 90-day lock is going to have a higher interest rate than a 15-day lock. What happens if the bank runs out of time, right? What if the contract is not ready to be completed? Closing is not going to happen within the prescribed period of time. Well, the lock can be extended, but there will almost certainly be a cost to the borrower to do so. Keep in mind, some banks have odd rules about extending lock periods. Some say you can only do it twice. Others say you can only do it in certain chunks. So maybe you only need a 1-day extension, but the only option is a 7 or a 15-day. And they're going to have to pay to extend the lock by 7 days, which can be expensive depending on the loan amount. So why is this important? You need to communicate any delays in closing to the bank, to that loan officer. You may presume, well, more time, every bank likes more time. It may be difficult depending on how long the borrower is locked for. What if a lock needs to be canceled? Well, you can cancel a lock, but most banks will impose a certain time period under which you can't relock without a penalty or without facing worst case scenario pricing. Moral of the story, communicate those things early. If you think a loan is not going to close on time, you may want to communicate that to the loan officer early on so they can cancel that lock quickly and burn through that 30 or 35-day period as quickly as possible.